Interest rates are now at a 2-decade-plus high. Back in December, Fed Chair Powell sparking optimism across the street with rhetoric around rate cut timing, but recent commentary has investors dialing back their expectations.
The question of when will it become appropriate to begin dialing back the amount of policy restraint in place, that begins to come into view and is clearly a topic of discussion out in the world, and also a discussion for us at our meeting today. We'll need greater confidence that inflation is moving sustainably toward 2% before it would be appropriate to ease policy. The recent data have clearly not given us greater confidence and instead indicate that it's likely to take longer than expected to achieve that confidence.
Only 36% of traders now pricing in the first rate cut coming in July. This week, we're going to get some more insights, though. We've got 2 new sets of economic data helping inform the Fed's thinking around monetary policy. We've got GDP out on Thursday and PCE, the Fed's preferred inflation gauge, coming out on Friday. So joining us in studio for more reaction, we have Michael Reid, RBC Capital Markets U.S. economist. Michael, thank you so much for being here in person. We mentioned some of the economic data coming out this week. Which one do you think the Fed is going to be looking at the most closely? I know they always look at Supercore PCE, but is there any chance that GDP could be a better indicator this time around?
Yeah, sure. Thanks for having me. So, we're looking at everything. Certainly, spending has been hot. We're looking for services spending to really drive most of the growth in terms of GDP. And I think that's a factor that's playing into the services price pressure that we've seen of late. So they'll be looking at Supercore. Also, you have to think about housing and how that factors into PCE. It has a little bit lower weight compared to CPI, but still there's some pressure there, and we've yet to see some relief coming from that component.
So looking out beyond the prints that we're going to get later this week and kind of the trends that we could maybe extract from that for the remainder of at least the first half into the second half of the year, how do you see these prints really setting the stage for maybe some of that growth that's you might expect to remain here for the second half of the year?
Yeah, so we really expect to see the labor market to remain tight. The continued retirement wave that we are seeing is going to put downward pressure on the unemployment rate, and that's really going to put upward pressure on wages. In addition, we do see a risk of slowdown coming from some of the headwinds, in particular federal student loans, but the Biden administration has come out with some new plans that have really kind of curbed our worry there. So looking ahead, we do see a tailwind in particular coming from consumer spending really being driven by the drawdown of retirement assets. And that's a measure that I think we as economists and forecasters have largely missed in this cycle. And that's something that's really creating a tailwind here for the economy.
Does it matter that the majority of the spending, in your view, then is coming from a certain age group of individuals that is driving the growth of the economy? Or is it just if that contribution number is high, we're getting strength?
No, not at all. In fact, it's a very good thing in the sense that you're going to have a larger share of the population that is driving that consumption, and they are no longer tied to the labor market. So, their confidence and their ability to spend is disconnected from their worries about losing a job. And on the flip side, as I said, that their exit from the labor market is going to put downward pressure on the unemployment rate, and that gives more confidence to consumers who do rely on their wage income to continue to spend and continue to pay down the debts that they do have.
But then isn't that bad news for the Fed? And at what point do we get to a position where it would be better, at least for the CEOs that Shauna and I speak with, to hear the Fed just say, we're actually not going to do anything this year, so that people can just kind of plan around an expected outcome?
Yeah, absolutely. I mean, the Fed's in a really tough spot right now. In addition to the election coming up, you have base effects that are going to come into play for PCE, in particular core PCE. So if we continue to see prints on a month-over-month basis that are above 0.2, that's really risking putting upward pressure on that Fed's preferred measure of inflation. If we see something higher, something like 0.25 or even 0.3 on a month-over-month basis, you're now shifting that narrative from no cuts into potentially hiking.